And what I wanted to mention there is let's take a look at the history of the oil prices. Now this is a very, very, very simplified oil price curve. And it's constructed from my personal memory. All these gray hairs came from managing service companies and divisions and operations through most of this. And I take a look at this, and this now looks very flat through here. But the reality of it was, this is approximately an inflation-adjusted curve. Okay, so the spike in the late 70s, early 80s was about $78 to $80 a barrel, and then we basically fluctuated from the 80s to the early 2000s in the $20 to $40 range. You remember all of those downturns? I remember each and every zigzag on there. So they seemed like big events, but now we're looking at it, and we see the run-up from 2003 up to $147 a barrel, followed by a drop to 40, and then a doubling of the price in the first half of this year to where it's at now, 60 to 80. Now, that's interesting in and of itself, and you can argue about where the curve is going to go from here. I'd like to point out two factors. Back in 1980, the run-up in price was artificially induced, largely by OPEC taking 15 million barrels of excess capacity off of the market. That 15 million barrels at the time was equal to 25% of the world's consumption. It's a huge amount of oil removed from the market. So naturally, that caused the price to run up. The price ran up, economic downturns came, and it took a long time to stabilize, but throughout this entire flat period, there was an excess capacity. Now it started out at 15 and declined to about 2 million barrels a day at this point. So excess capacity was gone. There was no overhang in the system of just-in-time inventory of supply of the oil and gas markets, and then we started the big run-up. Okay, now I'll grant you that in this spike there was a lot of, there might have been, I've heard various numbers as to the impact of the speculation in the oil price. Let's call it 50 bucks a barrel, something like that. So that would take the real price back down in here someplace. That's still a very significant run-up. Does it represent a macro shift? I don't know. As of today, there are 6 million barrels of excess capacity on the market. Some of that has been created by demand destruction, people driving less, economic activity less, and some of it has been created by removing capacity, productive capacity from the market, and some of it has been, and anyway, that's the number, 6 million barrels per day. Today, that is equal to 7% of the world's total consumption. So those who say that we are in a new situation, just like the last run-up in price, are missing two key points. Number one, this peak was artificially induced. This one was reality induced. Number two, the cushion that the world has to work with is much smaller. There's a much smaller margin of error. So I think the fundamentals of the oil patch are pretty solid. It's going to be with us for quite a while.